Hey guys, this is Alex Owire from ONG Tax and Accounting Services. So in this video, we're going to talk about when and how your Social Security benefit and disability benefit are subject to federal taxes. For the purpose of this video, I will basically lump these benefits together and just call them Social Security benefits. But whenever you hear me throughout this video talk about Social Security retirement benefit, I'm also referring to disability benefit as it relates to your federal taxes. So this video is going to be part one of several series that we'll be doing to cover Social Security taxes on the federal level. And in this case, we're going to look at single filer with a provisional income below the base amount. Now, to start off, let me throw a word of caution out there that this video is for educational purposes only, and it's not meant to be a legal or tax advice. And if at any point in time you need a legal or tax advice, always consult with a competent CPA or an attorney or an enrolled agent who can help you figure some of this out. Now, I'll also start off by sympathizing with you senior citizens and those on retirement and disability on how this whole thing plays out for you when it comes to preparing your tax return. I sympathize with you because the taxability rules as it relates to Social Security is so much complex that I really don't understand why Congress will make this law so complex, especially when you look at the kind of demographic that these taxes cover. For me, I think the laws are just too complex for someone that's a senior citizen that's on retirement and is probably very old and cannot understand the tax laws. It is also going to be a very complex situation to go through for someone who is disabled on how to file their tax return. But anyway, I hope that this video helps you explain some of the basic concept on how your Social Security is taxed. As a law-abiding taxpayer, you need to follow what Congress has set up. And so my job here is to try and make things easy for you to understand the basics of how your Social Security is taxed on the federal level. So we start off by looking at a very simple question. So I received this recently where the person that sent me this question says that he's a single filer on retirement. During 2021, he received SSA 1099 reporting a net payment of $36,000 from the Social Security Administration. He also received $7,000 in IRA distribution. And the question is his Social Security benefit taxable? And if it is taxable, how much federal taxes does he owe based on the information he has provided here? Now, to answer that question, let's just go ahead and build the foundation and figure out whether, based on all the facts that he has presented, whether any of his Social Security benefit is going to be taxable. So we're going to address the first question, whether the Social Security benefit is taxable. Now, Congress considered taxing only a portion of your Social Security benefit, and it's taxable up to 1/2 or 50% in excess of certain base amount. So in this video, we're going to explain the base amount. We're going to show you what the base amount is. For the purpose of determining the taxable portion of your Social Security benefit, there's really no distinction between the Social Security retirement benefit and the Social Security disability benefit. What this means is that any of these benefits are taxed the same way. So there's really no difference on how these benefits are treated. Now, Section 86 lays out a two-part formula to determine the portion of your Social Security benefit that you should be including in your gross income. So if you are someone that's on Social Security benefit or Social Security disability benefit, the Internal Revenue Code that lays out the foundation on how your Social Security will be taxed is in Internal Revenue Code Section 86. The formula uses a base amount and an adjusted base amount to determine the taxable portion of your Social Security benefit. Now let's look at the rules that establishes the base amount and the adjusted base amount. So Section 86C talks about the base amount and the adjusted base amount. And for the purpose of this section, this is how it's codified, right? This is what it says. I'm not going to read all this code because I've read this so many times. Whenever I come to this code, I know what to pick from here, depending on the situation I'm dealing with. In this case, I'm dealing with a single filer. So when I go to the base amount that's relevant for this video is 25,000. So if you're single filer, 25,000 is your base amount. If you're single filer, your adjusted base amount is 34,000. So between 25,000 and 34,000. So for a single filer, your base amount that we use to determine whether your Social Security is going to be taxed is these two numbers. Base amount is 25,000, adjusted base amount 34,000. All right, now let's summarize the rules for single filers. So with respect to a taxpayer who files single, the base amount and the adjusted base amount, as I have indicated earlier, is 25,000 and 34,000 respectively. And then under paragraph 1A and 2A of the section 86C, for single filers, Congress has established 25,000 as the base amount and 34,000 as the adjusted base amount. So I'm still repeating the fact. I just want you to remember that we're going to be working with these numbers, with this amount, the 25,000 and the 34,000. It's important that I repeat it so you know that these numbers are important in our calculation. So now that we know the base amount and the adjusted base amount, we want to know what portion of the Social Security benefit is going to be taxable for a single filer. 50% of that portion is taxable if we determine that your combined income is between 25,000 and 34,000. Now, we've brought in another word here, another phrase here that we're going to talk about very soon, combined income. Sometimes it's also referred to as provisional income. So we're going to talk about it very soon on how to arrive at your combined income. But it says that 50% of your Social Security will be taxable if your combined income is between 25,000 and 34,000. 85% of that portion is taxable if your combined income or your provisional income exceed or is more than 34,000. Now, what if your combined income or provisional income is equal to 25,000 or below? That means that 0% of your Social Security will be taxed. So it means that if your provisional income is 25,000 or below, you don't pay anything. You don't pay any taxes on your Social Security benefit that you received. Now let's look at what is a combined or provisional income. Now it includes your modified adjusted gross income. So when we talk about modified adjusted gross income, it means all of your other income, all of the other income you receive from other sources. So it could be wages, interest income, dividends, net income from self-employment, so many things. So all types of income comes together to make up MAGI. And when you're determining MAGI, which is the modified adjusted gross income, you do not factor in deduction. So it's basically all of your other income without the benefit of any deduction, credit, or anything like that. And that MAGI also includes tax-exempt interest. So yes, tax-exempt interest generally is not taxable, or it's not even taxable, but it's included in your modified adjusted gross income to determine what portion of your Social Security will be taxable. So we're building the foundation here. So first you need to know what your modified adjusted gross income. And once you know it, you add 50% of your Social Security benefit to it to get your provisional income. All right, so let's recap. So far, we know what our base amount is. We know our adjusted base amount, and then we know our provisional income. So far we know three things, which is good. So we're going to figure out the amount of federal taxes due based on the information we know so far. And then also in relation to the fact that the taxpayer has provided. So we are applying the rules to the fact. Now, the taxpayer said he received $36,000 from Social Security Administration. He also received $7,000 IRA distribution. So we're going to calculate his modified adjusted gross income. His total modified adjusted gross income is going to be $25,000. Now, how did we get that? So we took $7,000, the IRA distribution, And then we added 18,000, which is 50% of the Social Security benefit he received. So together, so 7,000 plus 18,000 gives us the provisional income of 25,000. Now we also know that based on the Section 86, for a single filer, your base amount for determining whether your Social Security or a portion of it is going to be taxable is 25,000 in the case of a single filer. So because this taxpayer's provisional income is actually equal to the base amount, it did not exceed the base amount of 25,000. So none of his Social Security benefit is going to be included in gross income. So meaning that all the 36,000 he received, he pays zero taxes on it. Nothing gets included in gross income. Therefore, the only income that's taxable in his case is the 7,000 IRA distribution. So now that we know that his taxable income is 7,000, let's also assume that his standard deduction for 2021 is 12,550. So when you back out 12,550 from this one, when you're preparing tax and you get a negative on this line, it basically means that you have zero taxes to pay. So your taxes is zero. So therefore, taxable income becomes zero. That's because the standard deduction is higher than his taxable income. So the taxes that he needs to pay is zero. All right, so we've been able to figure out that his taxable income is going to be zero and then he's going to have zero taxes. But how does it play out on the tax forms? So I'm going to show you both the Social Security worksheet that's used to calculate your taxable benefit, and then we'll also show you how it shows up on your 1040. So let's look at the Social Security worksheet 1, figuring out your benefit. So the same thing that we talked about, the same calculation that we did, it's also simplified on this worksheet. So as you can see, this worksheet started with 36,000 in Social Security benefit. It's actually figured out that 50% of 36,000 is 18,000, and it's added 7,000 to it. Your combined income or the provisional income is 25,000. Now, it also sets up the base amount here. So on line 9 here, it says that if you're single, then enter 25,000. So it's here on line 9, this worksheet is trying to establish that base amount that we got from Section 86. And then when you go all the way down, your taxable benefit, it says that enter the smaller of line 17 or line 18. Also enter the amount on 1040. Now, when you look at line 17 and 18, we have zero. There's nothing here. So none of this is going to be taxable. And also there's nothing here or zero because you have the combined income, which is equal to the base amount. So the taxpayer, even though he received Social Security benefit of 36,000, because of how low his income is, he's not going to be paying any taxes on that Social Security. So let's look at the 1040 as well. Now on the 1040, you would see that, yes, on line 6A, he reported his total Social Security benefit of 36,000. However, nothing was reported as taxable because of this worksheet calculation we did. And then we know that IRA distributions are taxable. And so the IRA distribution is here. So you have all this income going down to 7,000. And then the standard deduction is 12,550. Now, because the standard deduction is greater than the taxable income, his taxable income is going to be zero and taxes is therefore zero. So I hope this helps you guys out. Please subscribe, share, like, or if you have any questions, feel free to send me a message or comment in the comment section, and then I will be able to respond. Thank you very much and have a good day. Bye.